There is a simple, almost laughably low-tech habit that underpins one of the greatest fortunes ever assembled. It requires no advanced degree, no expensive software, and no insider connections. It is a practice so fundamental that we are taught it as children, yet so powerful that it has acted as the silent partner in the creation of a $100 billion empire. This habit is the secret weapon of Warren Buffett, and it has nothing to do with reading a balance sheet or calculating discounted cash flow, at least not at first. It is the act of writing, not for an audience, not for publication, but as a ruthless tool for clarifying his own mind. Buffett has famously said, "If you can't write it down, you don't understand it." This isn't a clever aphorism, it is the central operating principle of his financial life. It is the filter through which every major investment decision, every company acquisition, and every strategic maneuver must pass. The annual letters to Berkshire Hathaway shareholders, masterpieces of business wisdom read by millions, are merely the public-facing byproduct of this intensely private discipline. Their true purpose is not to inform the world, but to force one man in Omaha, Nebraska, to confront the stark, unvarnished logic of his own ideas before he risks a single dollar of his partner's capital. This commitment to writing is the ultimate defense against the most expensive mistake any investor can make: acting on a half-baked idea, a fleeting emotion, or a seductive but hollow narrative. In a world drowning in instant analysis, hot tips, and an endless stream of financial noise, the simple act of putting pen to paper is an act of rebellion. It is a declaration that you will not be swayed by the crowd, that you will not be a victim of your own cognitive biases, and that you will only allocate your precious capital to ideas that can withstand the harsh crucible of written interrogation. Today, we are not just going to talk about this habit, we are going to deconstruct it, reverse engineer it, and build it into a system that you can install in your own life. We will explore the origin of this practice in the earliest days of Buffett's career. We will forge the specific template he uses to test an investment thesis. We will uncover the psychological traps it is designed to dismantle, and we will extend its power beyond the stock market into the realm of executive decision-making and entrepreneurship. This is not another piece of investment advice. It is a lesson in applied epistemology. It's about learning how to think, and the path to thinking clearly, as we will discover, is paved with ink. This is the story of how the simple act of writing becomes the engine of profitable ideas and the bedrock of lifelong financial discipline. The foundation of this entire philosophy wasn't forged in the bustling headquarters of a global conglomerate, but in a small, modest office in Omaha in the mid-1950s. This is where a young Warren Buffett, barely in his mid-20s, began managing money for a small group of friends and family. He called it the Buffett Partnership. There was no grand ambition for a global empire, just a burning desire to perform and an almost sacred duty to the people who had entrusted him with their life savings. It was here, in this incubator of intense focus, that the writing habit was born out of pure necessity. The foundational anecdote begins not with a stock tip, but with a letter. From 1956 to 1969, Buffett wrote a series of semi-annual letters to his partners. These documents have since become legendary, but their initial purpose was profoundly practical. He was practicing a form of investing that was utterly alien to the average person. The go-go years of the 1960s were on the horizon, a time of speculative fervor where stories and glamour drove stock prices. Buffett, in stark contrast, was a disciple of Benjamin Graham, a quantitative, deep-value investor. He was buying obscure companies, engaging in complex arbitrage situations he called workouts, and buying what he termed generals, stocks that were statistically, demonstrably cheap based on their assets. How could he possibly explain this to his partners, who were doctors, lawyers, and neighbors, not financial analysts? The answer was that he had to write it down. These early letters were not marketing brochures. They were tools of education and, more importantly, tools of self-discipline. Imagine the scene. A young Buffett, sitting at his desk, the weight of his partners' financial futures on his shoulders. He couldn't just tell them, "Trust me." He had to articulate his strategy so clearly that they would not only understand it but also remain calm during the inevitable market downturns. In a letter from 1957, he meticulously explained his, quote, generals category. He didn't just say he bought cheap stocks. He wrote, usually the stock is paying a dividend and sells at a price which gives a good return. The issue is also selling at a price which is substantially below the value of the business to a private owner. He was defining his terms, creating a framework. In another letter, he explained his workouts, the special situations. He described them as transactions whose profitability depended on a specific corporate action, a merger, a liquidation, a spin-off, rather than the general mood of the market. He wrote, "We are dealing with the law of averages. I expect to have a portion of our funds in this category at all times." By committing this to paper, he was making a promise. He was drawing a line in the sand, defining the rules of the game he was playing. This act of writing did something far more important than reassuring his partners. It cemented the strategy in his own mind. He couldn't deviate, he couldn't get caught up in the speculative mania of the day. Because he had a written constitution, his own words would hold him accountable. Consider the immense pressure this created. Every 6 months, he had to sit down and explain his performance, not just the numbers but the reasoning behind them. If he had a bad year, like in 1966 when the partnership was up only 20.4% while the Dow was down 15.6%, a massive outperformance, but still a year where some individual stocks might have been down, he couldn't hide. He had to write about it. He had to explain the logic of his holdings and why he believed they remained sound. This process of regular written self-assessment prevented what psychologists call strategic drift. He couldn't just follow the latest trend or make an impulsive bet because he knew that in a few months he would have to sit down at that typewriter and justify it in cold, hard print. The letters became his conscience, his strategic anchor. He was not merely reporting on the past, he was actively shaping his future decisions. He was building an intellectual framework, brick by written brick. This discipline, forged in that small Omaha office, managing a few $100,000, became the unshakable foundation for the multi-hundred-billion-dollar Berkshire Hathaway. The habit of writing wasn't something he adopted once he became successful. It is the very thing that made him successful. It was the operating system that ran in the background, ensuring every decision was rooted in logic, clarity, and a profound understanding that could only be achieved by translating nebulous thoughts into concrete, written words. The power of this habit is not a matter of opinion or style. It is rooted in deep and well-documented psychological principles. The primary mechanism at play is a phenomenon known as the generation effect. This cognitive principle, studied extensively since the 1970s, demonstrates that information is far better remembered, understood, and integrated when it is actively generated by our own minds rather than passively received. When you read a financial analysis or listen to a pundit on television, you are a passive recipient. The ideas may seem to make sense, but they are fragile, unattached to your own cognitive structures. However, the moment you are forced to take those same ideas and write them down in your own words, to explain a company's business model, to articulate its competitive advantage, to justify its valuation, you are triggering the generation effect. You are not just consuming information, you are creating it. This act of creation forges powerful neural pathways. The struggle to find the right words, to structure the sentences, to build a coherent argument, is not a mere transcription of thought. It is the thought process itself, in its most rigorous form. The brain has to work harder, engaging more of its processing power, which in turn leads to deeper encoding of the material. This is why Buffett can recall the intricate details of investments made decades ago. He didn't just read about them, he wrote about them, generating the understanding himself. Beyond the generation effect, the act of writing serves as a powerful form of cognitive unloading. Our brains, specifically our working memory, have a very limited capacity. Trying to hold all the variables of a complex investment decision in your head at once is like trying to juggle a dozen balls. You have the company's financial history, its management team's track record, the competitive landscape, the industry trends, the valuation metrics, and your own emotional reactions all swirling around in your mental workspace. It's a recipe for cognitive overload, which inevitably leads to poor decision-making. We default to mental shortcuts, or heuristics, which are often riddled with biases. Writing solves this problem with elegant simplicity. By putting your thoughts onto paper or a screen, you are unloading them from your working memory. The page becomes an external hard drive for your brain. This frees up immense cognitive bandwidth. No longer are you spending mental energy just trying to remember all the pieces. Now you can use that energy for higher-level thinking. You can analyze the connections between the pieces. You can spot contradictions in your own logic that were invisible when they were just floating in your head. You can see the entire argument laid out, structurally, and assess its strength in a way that is simply impossible, with purely mental deliberation. This process of unloading and organizing is the very essence of clear thinking. It turns a chaotic jumble of ideas into a structured, logical framework, allowing the rational part of your brain to take control from the emotional, impulsive part. This is the cerebral magic behind the habit. It enhances memory and understanding through generation, while simultaneously expanding your capacity for deep analysis through cognitive unloading. It's a one-two punch that dramatically elevates the quality of thought. So how do we translate this powerful concept into a practical tool? We can create a foundational mental model called the pre-mortem journal. This isn't about writing a full, complex investment thesis just yet. This is about building the fundamental muscle, the core habit of writing before acting. This blueprint is designed to be simple, fast, and repeatable, making it easy to integrate into your life immediately. You will need a simple notebook or a digital document. For any financial decision that is more significant than buying a cup of coffee, whether it's buying a stock, investing in a new fund, or even making a large purchase, you will open to a new page and, before you commit any capital, you will write down the answers to 3 specific questions. The entire exercise should take no more than 15 minutes. Question 1. What is the core idea? In 1 or 2 sentences, state exactly what you are doing and why you expect it to be profitable. For example, I am buying shares of XYZ Corporation because I believe its new product line will capture significant market share, leading to higher than expected earnings growth over the next 2 years. This forces you to move beyond a vague feeling and state a clear, testable hypothesis. It's the beginning of a real investment process. Question 2. Why do I believe this is true? Under this heading, you must list, in bullet points, the key pieces of evidence that support your core idea. These cannot be feelings or opinions. They must be facts. For example, the new product has received overwhelmingly positive early reviews from tech critics. Pre-order numbers released by the company are 50% higher than for their last successful product. 2 major competitors have recently announced delays in their competing products. The stock is trading at a price-to-earnings ratio below its 5-year average. This step forces you to confront the difference between a good story and a good investment. A good story feels right. A good investment is supported by evidence you can write down. If you struggle to list at least 3 to 5 concrete pieces of evidence, it is a giant red flag that your idea is not yet fully formed. This is the first layer of the filter. Question 3, and this is the most crucial. What is the single biggest risk, and how would I know if I'm wrong? This forces you to actively fight against confirmation bias. You must articulate the one thing that would shatter your thesis. For example, the biggest risk is that the new product has a major technical flaw that isn't apparent yet. I would know I'm wrong if, within the first 6 months of launch, user reviews on major retail sites fall below a 4-star average, or if the company is forced to announce a product recall. This is profoundly important. You are defining your failure conditions in advance while you are still rational and unemotional. The pre-mortem journal is not about predicting the future. It's about establishing a clear, written record of your thinking at a single point in time. It is your intellectual baseline. By consistently practicing this simple 3-question exercise, You are building the foundational writing habit that underpins all sound investment decision-making. You are moving from a world of reactive, emotional choices to a world of proactive, evidence-based analysis, one written page at a time. To truly appreciate the power of this disciplined, writing-based approach, we must examine its opposite. We must explore the antithesis, the path walked by the 99% of market participants who consistently underperform. This is the path of the cocktail party tip investor. Their investment process begins not with quiet contemplation and a blank page, but with a snippet of conversation, a headline flashing across a screen, or an enthusiastic post on a social media forum. The idea arrives externally, cloaked in excitement and social proof. My brother-in-law made a killing on this new tech stock, or did you see that segment on the news? This electric vehicle company is the next big thing. There is no internal generation of the idea. It is passively received, and because it is delivered with confidence and urgency, it bypasses the brain's critical thinking faculties and plugs directly into the emotional centers of hope and greed. The cocktail party investor never engages in the act of writing, because the very idea of it seems absurd. Why would you need to write it down? The story is so simple, so compelling. The narrative is the analysis. Their entire decision-making process is verbal and fleeting. They might talk about the stock with friends, repeating the same exciting story they heard. Each retelling reinforces their belief, not through evidence, but through repetition. This is the echo chamber in action. They are not testing a hypothesis, they are performing a social ritual to validate a shared excitement. They will spend hours consuming information, but it is a highly selective process. They seek out articles, videos, and forum posts that confirm the initial exciting story. This is confirmation bias on steroids. They will ignore cautionary articles or dismiss them as FUD, fear, uncertainty, and doubt, spread by those who just don't get it. Because their thesis has never been written down, it exists only as a loose, malleable narrative in their mind. This makes it incredibly fragile. When the market turns against them and the stock price begins to fall, they have no logical anchor to hold on to. Their investment thesis wasn't built on a foundation of written evidence, but on the shifting sands of emotion and story. The financial consequences are as predictable as they are disastrous. With no written thesis to review, panic is the only logical response to a declining price. The story that was once so compelling now seems like a lie. The hope and greed that drove the purchase are replaced by the far more powerful emotions of fear and regret. They sell at the bottom, crystallizing their losses. Conversely, if the stock happens to go up initially, they have no written valuation or price target to guide their decision to sell. They are driven by pure greed, holding on far too long, often riding the stock all the way up and all the way back down again. The cocktail party investor's portfolio is a chaotic graveyard of past fads and forgotten stories. There is no strategy, no discipline, and, most importantly, no learning. Because they never wrote down why they bought, they can never perform an honest post-mortem on why they were wrong. They are doomed to repeat the same mistakes, forever chasing the next hot tip, trapped in a cycle of emotional decision-making that systematically destroys their capital. Their path is a stark reminder that in the world of investing, the absence of a simple writing habit is not a neutral choice. It is an active decision to embrace chaos and financial underachievement. The distinction between the written, disciplined approach and the verbal, emotional one is not merely philosophical. It manifests directly and powerfully in financial outcomes. The direct financial connection can be seen by looking at the very foundation of Warren Buffett's empire, the performance of the Buffett partnership from 1957 to 1969. Over that 13-year period, the partnership achieved a cumulative return of 796%, while the Dow Jones Industrial Average returned only 153%. The partnership never had a single down year. How was this possible during a period that included several recessions and periods of intense market volatility? The answer lies in the clarity of purpose forced by his writing habit. In his letters, Buffett clearly articulated his strategy of focusing on statistically undervalued securities and special situations, explicitly stating that his goal was to beat the Dow by an average of 10% per year. This written goal was not just a target, it was a constraint. It prevented him from taking foolish risks during the speculative frenzy of the late 1960s, a period known as the go-go years. While other hotshot fund managers were chasing high-flying tech stocks and concept companies with exciting stories but no earnings, Buffett was constrained by his own written mandate. He had to be able to explain any investment in terms of the clear, logical principles he had laid out for his partners. He couldn't buy a stock just because it was going up. As the market became more and more speculative and he found it increasingly difficult to find investments that fit his written criteria, he did something extraordinary. He gave the money back. In 1969, at the peak of the bull market, he liquidated the partnership, writing to his partners that he could no longer find opportunities that met his standards and that the environment was becoming too dangerous. 2 years later, the market crashed. His writing habit had provided the financial discipline to walk away from the table when the game was no longer rational. The average investor, the cocktail party tip follower, did the exact opposite. They piled into the market at the top, driven by stories and euphoria, and were financially annihilated. The absence of a written thesis meant they had no tool to gauge the market's insanity. This discipline, born from writing, directly translates into superior long-term portfolio performance. It creates a massive financial advantage in 2 ways. First, it dramatically improves the quality of your buy decisions. The simple filter of having to write down your reasoning will eliminate at least 80% of the low-quality, emotionally driven investment ideas that cross your path. This alone significantly reduces the number of unforced errors in your portfolio. Second, and perhaps more importantly, it revolutionizes your sell discipline. When a stock you own starts to fall, your written thesis is your rock. You don't ask, "What is the market doing?" You ask, "Is my original thesis, the one I wrote down, still valid?" If the facts underpinning your thesis remain intact, the price drop is not a threat but an opportunity. If the facts have fundamentally changed and your thesis is broken, you sell, regardless of the price, because your reason for owning the stock is gone. This transforms selling from a panicked, emotional reaction into a cool, logical, business decision. Over decades, this rational approach to buying and selling, born from the simple habit of writing, is the primary driver that separates the truly successful investor from the perpetually frustrated market participant. The financial connection is not indirect, it is the very essence of the game. Clarity forced by writing is profit. The initial act of writing down your thoughts in a journal is the first step, the lighting of the forge, but the next stage is about crafting a specific, powerful tool. It's about taking that raw material of thought and shaping it into the financial equivalent of a master key, the investment thesis. This is where we move from a general habit to a specialized skill. Forging a powerful investment thesis in writing is the crucible where vague notions are burned away, leaving only the hard, unyielding structure of a rational argument. It's a process that transforms a flimsy "I think this stock will go up" into a robust, defensible case that can withstand the pressures of market volatility and self-doubt. The perfect anecdote to illustrate this process is one of Buffett's most audacious and celebrated investments, American Express during the Salad Oil scandal of 1963. This story is a masterclass in how writing can synthesize a complex, chaotic situation into a single, clear, and immensely profitable decision. In November 1963, the financial world was rocked by a massive fraud. A company in New Jersey, Allied Crude Vegetable Oil, had secured huge loans from various Wall Street firms, including a subsidiary of American Express. The loans were collateralized by the company's inventory of salad oil, which was supposedly stored in giant tanks. The fraud was simple but brilliant. The tanks were mostly filled with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and its creditors were left holding worthless collateral. American Express's stock plummeted. The market was consumed by a single, terrifying question. Would American Express be held liable for the massive losses of its subsidiaries' clients? Panic filled the air. The narrative was that the company's reputation was shattered, and it could face bankruptcy from the crushing liability claims. The stock fell by nearly 50%. This was a moment of pure, unadulterated fear. But while everyone else was reacting to the headline, Buffett was beginning a process of deep inquiry, a process that would have been impossible to manage without the clarifying power of writing. He didn't start by looking at the stock chart. He started by asking the right question, a question he would have written at the top of a blank page. Is the fundamental, underlying business of American Express permanently impaired by this scandal? To answer this, he needed data, not emotion. He began what he called his scrappy gumshoe work. He went to restaurants and banks. He talked to merchants. He would have documented every conversation. On one side of his ledger, he would write down the evidence of panic, the falling stock price, the dire headlines in the Wall Street Journal, the fearful pronouncements of analysts. On the other side, he would meticulously record his own primary research. He'd note how customers were still using American Express travelers' checks without hesitation. He'd document that merchants were still proudly displaying the American Express Accepted Here sign. He observed that the core consumer behavior was unchanged. The scandal was a Wall Street story, but on Main Street, the American Express brand, its true competitive moat, was still intact. The crucial act would have been the synthesis of this data in writing. He would have structured the argument. Thesis: the market is incorrectly pricing a temporary, subsidiary-level financial problem as a permanent, brand-level catastrophe. He would then list the evidence. Point 1. The core businesses, traveler's checks and the charge card, rely on consumer and merchant trust, which my primary research indicates is unshaken. Point 2. The potential legal liability, while large, is likely manageable for a company with the earnings power of American Express. Point 3. At the current price, the market is valuing the entire, powerful franchise at a fraction of its true worth, meaning we are paying almost nothing for one of the best businesses in the world. By writing this down, he transformed a chaotic mess of fear, news, and data into a clear, logical, and actionable thesis. This written clarity gave him the conviction to act boldly. He invested 40% of the Buffett partnership's entire capital into American Express stock. It was an enormous bet, one that would have been psychologically impossible without the unshakable foundation of a written, evidence-based argument. Within a few years, the investment had multiplied in value, becoming a cornerstone of his early success. This is the power of the written thesis. It is the alchemical process that turns the lead of market fear into the gold of investment opportunity. The intellectual engine that drives this process of thesis building is a powerful philosophical concept championed by the scientist Karl Popper, the principle of falsification. Popper argued that the defining characteristic of a scientific theory is not that it can be proven true, but that it is structured in a way that it can be proven false. You can never definitively prove, for instance, that all swans are white, because you would have to observe every swan in existence. But you only need to find one black swan to falsify the theory. This principle is the bedrock of critical thinking, and it is the psychological key to a strong investment thesis. When you write your thesis down, you are not trying to create an unbreakable argument that will always be right. You are doing the opposite. You are creating an argument so specific and so clear that it becomes testable and, therefore, falsifiable. This is what separates professional analysis from amateur storytelling. A weak, unwritten investment idea is impossible to falsify. Consider the statement, "I'm buying this stock because it's a great company with a bright future." How could you ever prove that wrong? The terms great and bright future are vague and subjective. The idea is protected by its own ambiguity. Now consider a written thesis statement. I am buying this stock because its profit margins are set to expand from 10% to 15% over the next 24 months due to the implementation of its new cost-saving technology, leading to a share price of $150. This statement is powerful precisely because it is fragile. It is loaded with specific, testable claims. We can track the profit margins every quarter. We can monitor the rollout of the new technology. We have a specific time frame and a specific price target. If, after a year, the profit margins are stuck at 9%, the technology is facing major bugs, and the price is languishing, we have clear evidence that our thesis is wrong. The act of writing forces you to move from the world of unfalsifiable stories to the world of falsifiable hypotheses. This shift has a profound psychological effect. It forces intellectual honesty. When your reasons for owning a stock are just a loose narrative in your head, it's very easy to subtly shift your reasoning to fit new data. If the company's growth slows, you might tell yourself, "That's okay, it's becoming more of a value play now." You are retroactively fitting the story to the facts to avoid the psychological pain of being wrong. This is impossible when you have a written thesis. The page stares back at you with your original reasoning in black and white. You cannot pretend you bought it as a value stock if your thesis clearly states you bought it for its aggressive growth. The written document is an unforgiving mirror, reflecting the quality of your original thought and forcing you to confront your mistakes head-on. This practice of making your ideas vulnerable to evidence, of actively trying to create a thesis that could be proven wrong, is the single greatest defense against self-deception in investing. It installs a scientific critical thinking process where there was once only wishful thinking and storytelling. It is the psychological gauntlet that every profitable idea must survive. To operationalize this, we need a practical blueprint. We will now construct the one-page investment thesis, a concrete template you can use for every single stock-picking decision. This document will become the cornerstone of your investment process. It should be no more than a single page, because brevity forces clarity. You will divide the page into 5 distinct sections. Section 1 is the business. Here, you must answer 2 questions in simple language. How does this company make money? And who are its customers? You must be able to explain this so clearly that a reasonably intelligent person with no prior knowledge of the industry could understand it. If you cannot articulate the basic business model in a few sentences, you do not understand it well enough to invest. This simple step prevents you from investing in companies with overly complex or opaque operations you can't truly comprehend. Section 2 is the moat. This is the heart of any value investing approach. A moat is a sustainable competitive advantage that protects the business from competitors, just as a moat protects a castle. Here, you must identify and describe this advantage. Is it a powerful brand, like Coca-Cola's? Is it a network effect, like Facebook's? Is it a low-cost production process, like Geico's? Or is it high switching costs for customers, like Microsoft's? You must be specific. Simply writing, "It's a good brand," is not enough. You must explain why that brand allows the company to charge more or retain customers better than its rivals. If you cannot clearly identify and articulate a durable moat, you are likely looking at a commodity business, which is a much riskier investment. Section 3 is management. Here, you are assessing the people running the show. The key questions are, is management skilled at allocating capital? And are their interests aligned with shareholders? To answer this, you should look for evidence. Do they have a history of making smart acquisitions, or have they squandered money on foolish ones? Are they funding growth projects that generate high returns on capital? Do they own a significant amount of the company's stock themselves, meaning they will profit alongside you, or are they enriching themselves with excessive salaries and options while the stock languishes? This section forces you to remember that you are not just buying a ticker symbol, you are becoming a part owner of a business run by real people. Section 4 is valuation. This is where you connect the business quality to the price you are paying. It has 2 parts. First, what is my estimate of the company's intrinsic value? You don't need a complex financial model. It can be a simple calculation based on a price-to-earnings multiple you think is fair, or a discounted cash flow analysis. The key is to write down your logic. Second, what is my buy price and target price? You must state, I will buy this stock at or below X price, and I believe it is worth Y price. This creates a margin of safety and a clear goal. It turns investing from a guessing game into a disciplined exercise of buying assets for less than they are worth. Finally, Section 5 is the killer risk. This is the falsification principle in action. You must answer one question. What is the single biggest threat that would permanently impair the company and invalidate this entire thesis? Is it a new technology that could make their product obsolete? A key patent expiring? A heavy reliance on a single customer? You must identify the jugular vein of the investment. Writing this down not only prepares you for what could go wrong, but it gives you a specific variable to monitor throughout the life of your investment. This one-page document is your blueprint for rational stock picking. It is the physical manifestation of clear thinking, a shield against emotion, and the foundation of a disciplined professional-grade investment process. To fully grasp the revolutionary nature of this written, structured approach, we must once again visit the antithesis. We must understand the mindset of the story stock chaser. This investor is not buying a business. They are buying a narrative. They are seduced by a grand vision, a charismatic CEO, or a technological revolution that promises to change the world. Their investment process is not one of analysis, but of belief. They fall in love with the story, and this emotional attachment makes rigorous written analysis seem not only unnecessary but almost cynical. The story is so beautiful, so compelling, that to subject it to the cold, hard scrutiny of a one-page thesis would be to ruin the magic. This mindset was most prevalent and most destructive during the dot-com bubble of the late 1990s. During that period, an entire generation of investors was captivated by the story of the new economy. The narrative was that the internet was changing everything, and the old rules of business and valuation no longer applied. Companies with no revenue, no profits, and no discernible business model were awarded multi-billion-dollar valuations based on metrics like eyeballs or website traffic. The story stock chaser heard these narratives and believed. They would attend cocktail parties and excitedly talk about how a company like Pets.com was going to revolutionize the pet supply industry, without ever once writing down a single calculation of how it could possibly make money selling and shipping bags of dog food at a loss. They would champion companies like Webvan, which had a grand vision of online grocery delivery, but they never put pen to paper to analyze the crushing logistical costs and razor-thin margins that made the business model fundamentally unworkable. The refusal to write was a key feature of this mania. A one-page investment thesis for these companies would have been impossible to complete. Under the business model section, they would have had to write "sell products for less than they cost." Under valuation, they would have had to admit there were no earnings to value. Under killer risk, the page wouldn't have been long enough to list them all. The very act of attempting to write the thesis would have immediately exposed the absurdity of the investment. But the story stock chaser avoids this confrontation. They live in the comfortable, exciting world of the narrative. They consume news articles and watch TV segments that reinforce the story, creating a powerful echo chamber of belief. They mistake a rising stock price for a validation of the story, not realizing that in a bubble, a rising price is merely a reflection of greater and greater foolishness. When the bubble inevitably burst in 2000, the result was a historic wipeout of wealth. The story stock chasers lost everything. Because their belief was based on a narrative, not a written analysis, they had no framework for deciding when to sell. They held on, praying the story would come true all the way to the bottom. Their portfolios were a testament to the catastrophic financial consequences of prioritizing a seductive story over a written, falsifiable thesis. It stands as a timeless lesson. Narratives entertain, but a written thesis protects. The financial connection between a written thesis and a well-managed portfolio is direct and profound. A portfolio built upon a collection of one-page theses is not just a random assortment of stocks, it is a library of well-reasoned business ownership stakes. This structure fundamentally changes how you interact with and manage your wealth, especially during times of market stress. When a market panic hits, and they always do, the average investor sees a sea of flashing red numbers on their screen. Their portfolio is an abstract entity that is losing value at an alarming rate. The natural, human reaction is fear, which leads to the instinct to sell everything to make the pain stop. This is why most retail investors dramatically underperform the market. They buy in times of greed and sell in times of fear. The investor who has a binder, physical or digital, filled with one-page theses for each of their holdings experiences a market crash in a completely different way. They do not see a list of frightening ticker symbols. They see a collection of businesses that they understand deeply. When one of their stocks is down 30%, their first instinct is not to hit the sell button. Their first instinct is to pull out their one-page thesis for that company and reread it. They go through it, section by section. The business, has the way it makes money fundamentally changed? The moat, has its competitive advantage been breached? Management, have the leaders of the company done something foolish? Valuation, the price is now much lower, making the margin of safety even wider. The killer risk, has the specific risk I identified come to pass? This simple act of rereading your own written analysis is a powerful psychological circuit breaker. It yanks you out of the emotional reptilian brain that is screaming danger and engages the rational, analytical prefrontal cortex. You are no longer reacting to the market's madness. You are methodically re-evaluating your own business case. If, after reviewing the thesis, you conclude that nothing fundamental about the business has changed and that the market is simply panicking, the price drop is transformed from a threat into a magnificent opportunity. Your written thesis gives you the courage to not only hold on but to buy more, to be greedy when others are fearful, just as Buffett was with American Express. Conversely, if your review reveals that the killer risk has indeed materialized and your thesis is now broken, you sell. The decision is not driven by the price action, but by the invalidation of your written reasoning. This transforms your portfolio management from an emotional roller coaster into a rational, systematic, and business-like operation. This discipline is the key to surviving and ultimately thriving from market volatility. It systematically removes the biggest destroyer of wealth, emotion-driven decision-making, and replaces it with the logic and clarity that can only be found in your own written words. The act of writing an investment thesis is a powerful tool for making rational decisions, but its true psychological genius lies in its ability to act as a potent antidote to the cognitive biases that plague every human mind. These mental shortcuts, or heuristics, evolved to help us make quick decisions in a primitive world, but in the complex domain of financial markets, they are often disastrous. Writing forces a slower, more deliberate mode of thinking that allows us to identify and override these flawed mental programs. A perfect illustration of this is Buffett's investment in the Washington Post Company in 1973. This was a time of immense market turmoil. The Nifty 50 bubble had just burst. The economy was entering a painful period of stagflation, and the Watergate scandal was engulfing the nation, casting a pall over anything related to politics and media. Newspaper stocks in particular were deeply out of favor. The prevailing market sentiment, the powerful force of herd bias, was screaming sell. Everyone was focused on the short-term noise, the political drama, the rising price of newsprint, the threat of a recession. The herd was moving in one direction, driven by a shared pessimistic narrative. In this environment, it would have been incredibly easy for any investor to be swept up in the negativity, but Buffett was insulated from this emotional contagion by his writing process. He would have sat down with a blank legal pad and begun to deconstruct the situation, not based on the market's mood, but on the business fundamentals. He would have written down the objective facts. Fact 1. The Washington Post dominated its market. It was the leading paper in a wealthy, educated, and growing city. Fact 2. It owned powerful, valuable assets beyond the newspaper, including Newsweek magazine and several television stations. Fact 3. It possessed immense, untapped pricing power. It could raise its advertising and subscription rates significantly without losing business. A classic sign of a strong competitive moat. Fact 4. At the current market price, the entire company was valued at about $80 million, while Buffett's own conservative estimate of the intrinsic value of its assets was over $400 million. By writing these facts down, he created a logical fortress. The written words on the page were a direct counterargument to the emotional storm raging in the market. While the herd was chanting, quote, political risk, his paper was saying, monopoly franchise. While the herd was moaning about the economy, his paper was highlighting untapped pricing power. While the herd saw a hated stock, his paper showed a dollar bill selling for 20 cents. This act of writing it all down, the numbers, the assets, the competitive position, allowed him to physically see the massive disconnect between perception and reality. It gave him the psychological fortitude to ignore the crowd and make a concentrated bet, which would go on to become one of his most successful investments ever, turning an initial $10 million stake into over $1 billion. The written analysis was not just a record of his thoughts, it was the weapon he used to slay the powerful dragon of herd bias. The two most insidious psychological biases for an investor are confirmation bias and the endowment effect, and the writing process is uniquely designed to combat both. Confirmation bias is our natural tendency to seek out, interpret, and favor information that confirms our pre-existing beliefs. Once we decide we like a stock, our brain subconsciously filters the world to find evidence that we are right. We click on the bullish articles and skim past the negative ones. This creates a dangerous feedback loop of overconfidence. The endowment effect is our tendency to ascribe more value to things merely because we own them. A stock we own feels more special, more valuable than one we don't. This makes it incredibly difficult to sell a losing position, as doing so would mean admitting a mistake and losing something that feels like a part of us. A structured written thesis attacks these biases head-on. A well-designed thesis template, like the one we outlined, does not allow for a one-sided argument. It explicitly forces you to confront disconfirming evidence. The section on the killer risk is a direct injection of anti-confirmation bias serum. It compels you to stop looking for reasons you are right and to actively search for and write down the single most powerful reason you might be wrong. This simple act fundamentally changes your research process. You are no longer just a cheerleader for your own idea. You become its most skeptical critic. Similarly, the valuation section is a powerful weapon against the endowment effect. By forcing you to write down a specific estimate of intrinsic value before times you buy the stock, you are creating an objective benchmark. Let's say you write down that you believe a stock is worth $100 per share. If you buy it at $80 and it later falls to $50 due to bad news that invalidates your thesis, the endowment effect will whisper in your ear, "Hold on, it will come back." It's a part of your portfolio. But your written thesis will scream, "The reason I valued this at $100 is no longer true. My logic is broken." The written valuation provides a rational anchor that prevents your emotional attachment to ownership from dragging you down with a sinking ship. The act of writing externalizes your reasoning, separating it from your ego and your emotions. It creates an objective document that you can consult, turning a psychological battle against your own worst instincts into a simple, logical procedure of checking your work. To supercharge this defense against bias, we can add one more step to our writing process. This is an advanced mental model we can call the devil's advocate paragraph. It is simple in practice but psychologically profound in its effect. After you have completed your entire one-page investment thesis, after you have laid out your brilliant, compelling, evidence-based case for why this investment is a surefire winner, you will take a deep breath, turn the page, and perform an act of intellectual treason. You will write one additional paragraph, but this time, you will write it from the perspective of your smartest, most ruthless, and most skeptical competitor. For the length of this one paragraph, your goal is not to be right. Your goal is to be devastatingly, persuasively wrong. You must argue, in writing, as convincingly as possible, that your own thesis is a piece of foolish, naive garbage. You must inhabit the mind of the bear. What are they seeing that you are missing? What weaknesses in your argument are you subconsciously papering over? You must attack your own moat section. The so-called brand loyalty is a relic of the past. New, agile competitors are stealing market share with a superior product at a lower price. You must savage your valuation section. The earnings used in that calculation are at a cyclical peak. A reversion to the mean will cut the company's profitability in half, revealing the stock to be wildly overpriced. You must pour scorn on your management section. The CEO's past success was a matter of luck and a bull market. They have never been tested in a real downturn and lack the operational discipline to navigate it. This exercise feels unnatural and uncomfortable, which is a sign that it is working. It is a forced dose of intellectual humility. It is a deliberate, systematic attempt to trigger your own confirmation bias in reverse. The devil's advocate paragraph is arguably the most valuable part of the entire written document. In 9 out of 10 cases, it will simply strengthen your conviction. By confronting the strongest counter-arguments and finding them lacking, you will have a much deeper and more battle-tested understanding of your own position. But in that 1 case out of 10, the exercise will save you from making a terrible mistake. As you write from the opposing perspective, you will stumble upon a flaw in your own logic that is so glaring, so undeniable, that your entire thesis crumbles. It is a moment of painful but profitable enlightenment. You will have discovered the fatal error in your thinking not by losing money in the market, but in the safety of your own journal. This simple, written exercise is one of the most powerful tools for critical thinking and financial discipline available. It is the final, brutal stress test that separates a merely good idea from a truly great investment-worthy one. Once again, to see the light, we must appreciate the darkness. The path of the 99% is embodied by the echo chamber investor. This individual does not seek truth. They seek validation. Their investment process begins with a belief, and their entire intellectual energy is dedicated to defending that belief against all intrusion. They construct a carefully curated information environment, a digital fortress where their chosen stock is always a hero and any skepticism is the work of villains. They follow the company's CEO on social media. They join online forums and subreddits dedicated to the stock. They subscribe to newsletters that promote it, and they tune into financial news channels that feature bullish analysts. Every piece of information they consume is designed to reinforce their initial conclusion. This is not a search for knowledge. It is the construction of a secular religion. Inside this echo chamber, a powerful group dynamic takes hold. Bullish arguments are celebrated and amplified. Skeptical viewpoints are mocked, downvoted, and dismissed as FUD, or the work of page shorters. A unique jargon develops, creating a sense of a special, initiated group that gets it while the rest of the world is blind. The echo chamber investor becomes psychologically incapable of engaging with contrary evidence. When the stock price falls, they don't question their thesis. Instead, they turn to the echo chamber for an explanation that preserves their worldview. The falling price is not evidence of a business problem. It is proof of a conspiracy. It is market manipulation, illegal short selling, or dark pool trickery. The narrative shifts from, "This is a great business," to, "We are noble warriors fighting a corrupt system." This allows them to hold on to a losing position indefinitely, not as an investment, a business ownership stake, but as a badge of identity. The idea of writing a devil's advocate paragraph is completely alien to the echo chamber investor. It would be an act of heresy. Their entire intellectual framework is built on the premise that there is no valid counterargument. To even attempt to write one would feel like a betrayal of the cause, a concession to the enemy. Their mind is closed, locked, and barricaded. This is why they are destined to fail. Markets are dynamic, businesses change, and facts on the ground evolve. The investor who cannot entertain the possibility of being wrong is an investor who cannot adapt. They will ride their story stocks all the way down, their conviction hardening with every tick down in price, their losses mounting. all the while finding comfort in the chorus of other believers who are sharing the same fate. The echo chamber provides immense psychological comfort, but it comes at the price of your portfolio. It is a stark reminder that the refusal to challenge one's own ideas in writing is a direct path to financial ruin. The financial cost of these psychological biases, left unchecked, is not theoretical. It is a quantifiable drag on your wealth. Confirmation bias, in particular, leads to one of the most common and destructive portfolio management mistakes: holding on to a losing investment long after the original thesis has been broken. Let's call this the denial tax. Imagine an investor in 2021 who bought a high-flying technology stock. Their thesis, likely unwritten and based on a narrative of endless growth, was validated by a rising stock price and a bullish echo chamber. Then, in 2022, the environment changed. Interest rates rose, growth slowed, and the stock fell 70%. The facts had changed, but the investor's confirmation bias was now in overdrive. They ignored the company's disappointing earnings reports and focused instead on hopeful CEO interviews. They ignored the analyst downgrades and clung to the bullish posts in their online forum. They refused to sell, telling themselves it was a long-term hold. The financial result is devastating. That 70% loss requires a subsequent gain of 233% just to get back to even. By refusing to confront the evidence that their thesis was broken, the investor locked in a catastrophic loss of capital and, just as importantly, a massive loss of opportunity cost. That capital could have been redeployed into a healthier investment. The writing habit, specifically the practice of conducting a regular thesis review, is the direct antidote to the denial tax. Imagine the same scenario, but with a disciplined, writing-based investor. When the stock begins to fall, they pull out their one-page thesis. They see their killer risk section, where they wrote, "A sharp rise in interest rates could compress the high valuation multiple this stock commands." They look at their valuation section and see that their growth assumptions are no longer being met by the company's quarterly reports. The written document provides an objective, unemotional checklist. The conclusion is inescapable. The thesis is broken. They sell the stock, perhaps at a 20% loss. This is painful, but it is a world away from a 70% loss. They have preserved the vast majority of their capital, which is now free to be invested in a new, more promising opportunity. This is the essence of professional risk and portfolio management. It is not about avoiding losses entirely. That is impossible. It is about cutting your losses short when you are wrong and letting your winners run when you are right. The written thesis is the tool that allows you to know the difference. It provides a clear, predefined set of conditions for when your initial judgment was incorrect. This financial discipline, rooted in the simple act of writing, is what prevents one or two bad decisions from derailing an entire financial future. It replaces the costly emotionalism of hope and denial with the profitable logic of a thesis-driven process. Over an investing lifetime, the cumulative financial gap between the investor who pays the denial tax on every mistake and the one who uses writing to enforce a sell discipline is staggering. It is the difference between stagnation and compounding, between frustration and financial freedom. The discipline of clear thinking, forged through writing, is not a tool exclusively for stock pickers. Its true power is revealed when it is scaled up and applied to the broader and more complex challenges of running a business and making major capital allocation decisions. This is the transition to the CEO mindset. For Warren Buffett, the same intellectual process he uses to analyze a stock is deployed when he considers acquiring an entire company. The stakes are exponentially higher, involving billions of dollars and the livelihoods of thousands of employees, which makes the need for written clarity even more acute. A phenomenal example of this is Berkshire Hathaway's acquisition of the BNSF Railway in 2009 for an astounding $44 billion. This was not a passive investment, it was an all-in bet on the economic future of the United States. A decision of this magnitude could never be made on a hunch or a gut feeling. It had to be the product of a clear, powerful, and written thesis. The context of the decision is crucial. It was late 2009. The The world was still reeling from the great financial crisis. Fear and uncertainty were rampant. Making a massive, multi-billion-dollar investment in a cyclical business like a railroad seemed, to many, like an act of insanity. But Buffett's process, as always, began with a blank page, not the noise of the headlines. He would have written a detailed memo, a private white paper for himself and his partner Charlie Munger, laying out the strategic rationale. The thesis would have been built on a series of powerful, long-term pillars. Pillar 1. The enduring moat. He would have articulated how railroads possess an irreplaceable infrastructure advantage. You simply cannot replicate a nationwide rail network. This creates a powerful duopoly in the United States, insulating BNSF from cutthroat competition. Pillar 2. The fundamental cost advantage. He would have detailed the physics and economics of rail versus trucking. A single train can move a ton of freight over 400 miles on a single gallon of fuel. For moving massive quantities of goods over long distances, trucking can never compete on cost or fuel efficiency. This is a durable, physics-based advantage that will only grow more significant as fuel costs rise over the long term. Pillar 3. The ultimate bet on America. He would have written about how BNSF is a vital artery of the American economy. It carries everything from the grain that feeds the country, to the coal that powers it, to the consumer goods that fill its stores. A bet on BNSF, he would articulate, is a bet on the long-term, inexorable growth of U.S. GDP. It was a way to buy a slice of the entire economic pie. By committing this grand, sweeping thesis to paper, he was able to look past the short-term fear of the financial crisis and focus on the unassailable logic of the century-long investment case. The written document provided the clarity and conviction needed to make a decision that would redefine Berkshire Hathaway for the next generation. It is the ultimate example of the CEO mindset, using writing to distill immense complexity into a simple, powerful, and actionable strategic vision. The psychological principle at play in this type of high-stakes executive decision-making is the fight against the planning fallacy. This is a pervasive cognitive bias, first identified by Daniel Kahneman and Amos Tversky, that causes us to consistently underestimate the time, costs, and risks associated with future actions, while simultaneously overestimating their potential benefits. Our brains are naturally wired for optimism. When we envision a new project, whether it's a corporate acquisition, a startup launch, or a personal career change, we tend to focus on the best-case scenario. We imagine a smooth process, enthusiastic customer adoption, and quick success. We subconsciously ignore the potential for unexpected delays, competitive responses, logistical nightmares, and market shifts. The planning fallacy is the silent killer of countless business ventures and strategic initiatives. The most potent antidote to the planning fallacy is the disciplined act of writing a detailed plan. The process of translating a grand vision into a written document forces a confrontation with the messy, inconvenient details that our optimistic brains would prefer to ignore. When you have to write down a project timeline, you are forced to think through each individual step, which often reveals that your initial estimate was wildly unrealistic. When you have to write down a detailed budget, you are forced to account for line items you hadn't even considered, like legal fees, insurance, and contingency funds. When you have to write down a risk analysis, you are forced to think about what your competitors might do, what technological changes could disrupt your plan, and what external economic factors are beyond your control. This process feels tedious and pessimistic, which is precisely why it is so valuable. It is a necessary counterbalance to our natural, and often dangerous, optimism. For an entrepreneur or a CEO, writing a business plan or a strategic memo is not about creating a document to show to investors. Its primary value is internal. It is a tool for self-interrogation. It's how you test your own vision for feasibility. It's how you move from a great idea to a workable strategy. Buffett's decision on BNSF wasn't just about the grand vision of betting on America. His written analysis would have included deep dives into the details, the state of the railway's track and equipment, the structure of its labor contracts, its capital expenditure requirements, and the regulatory environment. Writing forces this granular level of thought. It systematically dismantles the planning fallacy by replacing a rosy, abstract vision with a concrete, detailed, and realistic assessment of the challenges and opportunities ahead. It is the crucial bridge between a brilliant idea and its successful execution. We can distill this executive-level thinking into a powerful mental model for anyone facing a major business or life decision. We'll call it the memo to the board. Even if your board of directors is just you and your spouse or you alone, the formality of this written exercise will dramatically improve the quality of your decision-making. Before you commit significant capital, time, or energy to a new venture, be it starting a business, buying a property, or changing careers, you will write a formal 2-page memo. This memo must contain 5 specific sections. Section 1 is the proposal. In a single, clear paragraph, state the exact decision you are proposing to make. For example, this memo proposes the allocation of $50,000 in capital and 20 hours per week of founder time to launch an e-commerce business selling artisanal coffee beans. No ambiguity. Section 2 is the rationale. Here you must explain why this is the single best use of your resources right now, why this business and why now. This section should detail the market opportunity, the target customer, and your unique competitive advantage. It is the core of your strategic thesis. Section 3 is the financials. You must build a simple financial projection. What are the startup costs? What are your projected revenues and expenses for the first 3 years? What are the key metrics you will use to track success, such as customer acquisition cost and lifetime value? This forces a confrontation with the economic reality of your idea. Section 4 is the alternatives. This is a crucial and often overlooked step. You must list at least 2 other alternative uses for the same resources, the capital, the time, that you are not trained pursuing. For example, Alternative A, invest the $50,000 in a low-cost index fund. Alternative B, use the resources to get an additional professional certification to increase earning power in my current career. Then, you must write a paragraph explaining exactly why the proposed e-commerce business is a superior choice to these alternatives. This prevents tunnel vision and ensures your decision is not just a good idea, but the 20-post idea among your available options. Finally, Section 5 is the go-no-go criteria. Here, you must pre-commit to a set of conditions under which you would reverse or pivot from this decision. For example, if, after 1 year, the business has not achieved a gross margin of at least 40% and is not on a path to profitability within 24 months, we will terminate the project and reallocate the remaining capital. This is your escape hatch, your predefined exit strategy, defined while you are still rational and unemotional. The memo to the board is a professional-grade decision-making framework. It elevates your thinking from that of a hopeful amateur to that of a disciplined CEO, ensuring your most important life and business decisions are backed by the full force of written clarity and strategic rigor. The world of business is littered with the ghosts of brilliant ideas that failed in execution. The antithesis of the writing-driven CEO mindset is the visionary entrepreneur who can't execute. This archetype is a master of the verbal pitch. They are charismatic, passionate, and incredibly persuasive. They can stand on a stage and paint a vivid, inspiring picture of the future. They can mesmerize investors and attract talented employees with the power of their story. They speak in grand terms about disrupting industries, changing paradigms, and making the world a better place. The problem is that their talent begins and ends with the spoken word. They are allergic to the tedious, unglamorous work of writing a detailed plan. When you ask the visionary entrepreneur for their business plan, they will tell you that plans are useless. It's all about agility and execution. When you ask for financial projections, they will wave their hands and talk about the trillion-dollar total addressable market. When you ask about their capital allocation strategy, they will talk about their vision for growth. Their entire operation is built on a foundation of improvisation and passion. They raise millions of dollars based on their compelling story, but once the money is in the bank, there is no written, disciplined roadmap for how it should be spent. The capital is burned through with alarming speed on vanity projects, marketing campaigns with no clear return on investment, and hiring sprees that are not tied to specific business objectives. There is no written budget to hold them accountable, no documented strategy to guide their choices. The team around the visionary becomes deeply frustrated. Meetings are circular and inconclusive because there are no written proposals to debate and refine. Strategic priorities shift from week to week based on the founder's latest conversation or flash of inspiration. There is a constant state of motion, but no forward progress. The business is all sizzle and no steak. Ultimately, the lack of written discipline proves fatal. Competitors who may have had a less exciting vision but a more detailed, written plan will methodically out-execute them. The visionary's company burns through its cash, misses its targets, and quietly fades into obscurity. It is a tragic and common story in the world of entrepreneurship. It serves as a powerful cautionary tale that a brilliant vision, without the clarifying and grounding force of a written plan, is nothing more than a hallucination. The path from visionary idea to tangible success is paved with the ink of a well-written strategy. The ultimate financial advantage of the writing-driven CEO mindset is quantified by one of the most important metrics in business, return on invested capital, or ROIC. ROIC measures how effectively a company is using its money to generate profits. A company that consistently generates a high ROIC is a company that is creating value. A company with a low ROIC is one that is destroying it. The direct financial connection is this. A culture of disciplined, writing-based decision-making leads directly to a higher and more sustainable ROIC. When a company's leaders make major decisions, whether to build a new factory, launch a new product line, or acquire another business, based on detailed, written memos that have been rigorously debated, they are far more likely to allocate capital to projects that will generate high returns. Consider two companies. Company A operates on the visionary model. The CEO has a gut feeling about a new market and directs the team to pour millions of dollars into it based on a few passionate speeches. There is no written analysis of the competitive landscape, no detailed financial projections, no debate over alternatives. Company B, modeled after Berkshire Hathaway, will not spend a single dollar until a detailed written proposal has been circulated. The memo must lay out the business case, the expected returns, the risks, and the alternatives. The leadership team debates the written document, pokes holes in its logic, and refines it. Only when the written case is unassailable does the company allocate the capital. It is almost a statistical certainty that Company B will have a dramatically higher ROIC over the long term. It avoids the value-destroying pet projects and impulsive bets that plague companies run on verbal command and charisma. This is the secret to Berkshire Hathaway's phenomenal long-term success. It is not just a holding company, it is a capital allocation machine. Warren Buffett's primary job is to take the cash generated by Berkshire's operating businesses and reinvest it in opportunities, either public stocks or private companies, that will generate the highest possible returns. His tool for ensuring this is done effectively is not a complex algorithm, but the simple, rigorous discipline of his writing-based analysis. This discipline is reflected in Berkshire's financial statements. Its consistent ability to generate returns on capital far in excess of the average American corporation is the tangible, quantifiable result of a 50-year commitment to clear thinking, forced by the habit of writing. For any entrepreneur or business leader, the lesson is clear. If you want to build a business that creates lasting value, you must build a culture where important decisions are not just discussed, but are argued and justified in writing. The financial health of your enterprise depends on it. The final pillar of this philosophy is the one that elevates it from a mere habit into a lifelong system for compounding success. It's the recognition that the true power of writing is not just in the moment of decision, but in the creation of an archive of your own thinking. This practice of documenting your intellectual journey creates a feedback loop that allows you to learn, adapt, and improve at an accelerating rate. It is the engine of intellectual compounding. The most powerful anecdotes in this regard are not Buffett's successes, but his failures, and specifically, his willingness to analyze them in writing for all the world to see. A prime example is his candid discussion of his 1993 acquisition of Dexter Shoe Co. At the time, Dexter was a profitable American shoe manufacturer with what appeared to be a strong brand. Buffett was so confident that he paid for the acquisition not with cash, but with Berkshire Hathaway stock, a currency he viewed as precious and was famously reluctant to part with. The decision turned out to be a catastrophe. Dexter's supposed competitive advantage was quickly obliterated by a flood of cheap imported footwear. The business's profitability collapsed, and eventually it was worthless. Buffett had made a monumental error. Many CEOs would have buried this mistake, hoping the market would forget. Buffett did the opposite. In his 2007 letter to shareholders, he wrote about it with brutal honesty. He called the Dexter acquisition his worst deal ever, not just because the business failed, but because he had used Berkshire stock to pay for it. He wrote, "I gave away 1.6% of a wonderful business to buy a worthless business." He then performed the crucial act. He dissected the mistake in writing. He explained that he had failed to correctly analyze the company's lack of a sustainable competitive moat. He had bought a business that was vulnerable to low-cost foreign competition, a lesson he thought he had already learned. By writing about the failure so openly and analytically, he accomplished two things. First, he was holding himself publicly accountable, reinforcing a culture of intellectual honesty at Berkshire. But more importantly, on a personal level, he was encoding the lesson in the deepest possible way. The public act of writing down his mistake, of deconstructing the flawed reasoning that led to it, ensured that he would never forget it. The pain of the financial loss was transformed into a permanent, invaluable piece of wisdom. This is the ultimate power of maintaining a written record of your decisions. It allows you to learn from your mistakes in a systematic way. Your failures are no longer just painful memories. They become the most valuable entries in your personal journal of judgment, providing a return in the form of wisdom that will inform all of your future decisions. This is the heart of self-improvement and genuine investor education. This process of learning from a written record is a perfect example of what psychologists and performance experts call deliberate practice. The concept, popularized by Anders Ericsson, is that the key to developing true expertise in any field is not just putting in thousands of hours of experience, but engaging in a specific type of practice that involves focused attention, goal setting, and, most importantly, immediate and informative feedback. Experience alone is not enough. An investor who has been, quote, in the market for 30 years but has never systematically analyzed their past decisions has not had 30 years of experience. They have had 1 year of experience, repeated 30 times. They are trapped in a loop, making the same types of mistakes over and over because they lack a feedback mechanism to learn from them. An archive of your past written investment theses is the ultimate feedback loop for an investor. It is the raw material for deliberate practice. When an investment turns out poorly, you can go back to your one-page theses, written when you were objective and rational, and see precisely where your thinking went wrong. Were your growth assumptions too optimistic? Did you misjudge the strength of the company's moat? Did you fail to identify the key risk? The written record provides specific, undeniable feedback. It tells you not just funners that you were wrong, but why you were wrong. This is the kind of feedback that drives real improvement. Conversely, when an investment is a spectacular success, the journal is equally valuable. You can go back and analyze what you got right. Was it your valuation insight? Your assessment of management? This allows you to understand and replicate your successes, rather than attributing them to simple luck. Without a written record, this entire process of deliberate practice is impossible. Your memories of past decisions are notoriously unreliable, colored by hindsight bias and ego protection. You will remember your successes as being the result of genius and dismiss your failures as bad luck. The written record cuts through this self-deception. It is an honest and unforgiving coach, providing the objective feedback necessary to turn mere experience into true, compounding expertise. To install this powerful learning system in your own life, we will create our final blueprint, the Decision Journal. This is the culmination of everything we have discussed. You will continue to create a one-page thesis for every significant investment decision you make. You will store these theses, chronologically, in a single physical binder or a dedicated digital folder. This becomes your personal archive, the library of your financial mind. But the crucial step, the one that ignites the compounding of intellect, is the annual review. Once a year, perhaps on New Year's Day or your birthday, you will set aside a few hours to sit down with your decision journal. You will go through every single thesis for an investment you made over the past several years. For each one, you will pull out a new sheet of paper or open a new document and write a short, one-paragraph addendum. This addendum will have 3 simple subheadings. First, what I got right. Here, you must identify the parts of your original thesis that proved to be accurate. Be specific. My analysis of the company's brand power was correct, as they were able to raise prices by 10% without losing market share. Second, what I got wrong. This requires brutal honesty. I dramatically underestimated the speed at which a new competitor could replicate their technology, which eroded profit margins faster than I expected. Third, and most importantly, the key lesson. Here, you must distill the experience into a single, memorable principle that you can apply in the future. For example, the key lesson is to be more skeptical of companies in rapidly changing technological fields, and to pay more attention to the balance sheet than to the income statement in such situations. This formal, written process of review and reflection is the engine of deliberate practice. It forces you to learn from both your wins and your losses. It turns your personal investing history into a rich dataset from which you can extract invaluable, customized wisdom. The Decision Journal is not just a record, it is a machine for getting smarter. Over 5, 10, 20 years, the cumulative effect of this annual review is immeasurable. It ensures that you are always learning, always adapting, and always sharpening your most important financial asset, your judgment. The antithesis to this learning machine is the all-too-common amnesiac investor. This individual has no system for learning because they have no record of their past thinking. Their investment journey is a blur of forgotten trades, half-remembered rationales, and repeated errors. They are trapped on a hamster wheel of their own making. The amnesiac investor buys a hot tech stock at the peak of a cycle and gets burned. They swear off speculative nonsense. But 2 or 3 years later, a new cycle begins with a new set of exciting stories, and they find themselves drawn in again, making the exact same mistake with a different ticker symbol. They have no memory of the specific reasoning that led to their previous failure, only a vague, emotional scar. They cannot learn from their mistake because they cannot recall it with any clarity. Their investment process is governed by what feels good right now, with no connection to the hard-won lessons of the past. When you talk to the amnesiac investor about their past holdings, they will struggle to explain why they bought or sold them. I think someone recommended it to me, or it just seemed like a good idea at the time. Their financial history is a fog. Because there is no record to review, there is no possibility for a post-mortem. They are like a doctor who treats patients without ever reading their medical history, destined to prescribe the wrong medicine over and over again. Their portfolio performance reflects this lack of learning. It is a chaotic series of ups and downs, with no discernible upward trend over the long term. They are always active, always trading, but never making real progress. They are perpetually stuck at the beginner level of the game. The amnesiac investor is a tragic figure, because they often possess the intelligence and the capital to succeed. Their only missing ingredient is a system for learning, a system that begins and ends with the simple, powerful act of writing their decisions down. Their story is a final, stark warning that in the game of investing, an unrecorded thought is a lesson unlearned, and an unlearned lesson is a future loss already guaranteed. The direct financial connection of this final pillar is the most powerful of all, the concept of intellectual compounding. We all know how financial compounding works. Interest earns interest, and over time, the growth becomes exponential. The same principle applies to wisdom, but only if you have a system to capture and reinvest it. The decision journal is that system. Each written decision and each subsequent written review is like making a deposit into your intellectual capital account. The lessons learned from one decision become the wisdom that informs the next 10. The mistake you analyze and deconstruct in year 1 prevents you from making a dozen similar, costly errors in the years that follow. The successful insight you identify and understand becomes a mental model you can deploy again and again with increasing skill. This process doesn't just lead to linear improvement, it leads to an accelerating rate of return on your judgment. In the early years, the learning is slow and the mistakes are many. But as your journal grows, so does your database of personal experience and extracted wisdom. You begin to recognize patterns in markets, in businesses, and, most importantly, in your own behavior. Your decision-making becomes faster, sharper, and more accurate. The financial result is a portfolio that begins to reflect this intellectual compounding. The gap between an investor who diligently maintains a decision journal and one who does not is small in year 1. By year 5, it is noticeable. By year 20, it has become an unbridgeable chasm. The amnesiac investor is still making the same rookie mistakes, while the journaling investor is operating with a level of insight and discipline that is 2 decades in the making. This is the ultimate financial advantage. It is not about a single hot stock tip or a secret formula. It is about committing to a simple, lifelong process of written reflection that allows your wisdom to compound alongside your capital, creating a powerful, self-reinforcing engine for sustainable, long-term wealth creation. You have just invested a significant amount of your time and attention, and in doing so, you have acquired a powerful piece of mental machinery. You now possess the blueprint for the one-page thesis and the decision journal, a complete, closed-loop system for transforming fuzzy ideas into clear, rational, and profitable decisions. You have moved beyond the world of tips and speculation. You no longer have to guess what you think. You now have a tool to know what you think, to test it, to defend it, and to learn from it. This is a fundamental upgrade to your cognitive operating system, and it will serve you not just in your portfolio, but in every important decision you make for the rest of your life. But it is crucial to understand that this system, as powerful as it is only one part of a much larger intellectual network. What we have built together today is the perfect, high-performance engine for decision-making. It is clean, efficient, and ruthlessly logical. But an engine, no matter how perfectly engineered, is useless without fuel. The fuel for this engine is the quality of the ideas you feed into it. Warren Buffett's true genius is not just that he has a disciplined process for thinking. It is the extraordinary quality of what he thinks about. His mind is an arsenal of powerful mental models for understanding the world, models for assessing a competitive moat, for judging the character of management, for calculating intrinsic value, for understanding the psychology of markets. The writing habit is the framework that holds it all together, but the models themselves are the source of the power. The video that is now appearing on your screen is about that fuel. It is the next piece of the map. Think of the decision-making system you just built as the hardware. The video waiting for you is a piece of essential software designed to run on it. It is the link that connects the process of clear thinking to the substance of great business and investment ideas. It details one of the core mental models that Buffett plugs into his own framework, a specific way of seeing the world that unlocks a new dimension of insight. You have already proven that you are part of the small minority of people who value deep thinking and are committed to the discipline required for true success. You have built the engine. The only question now is, are you ready to fuel it? The journey to becoming a truly sophisticated investor, a master of your own financial destiny, continues with the click you are about to make. Don't just watch another video. Take the next deliberate step in completing your mental arsenal.